We are doing Carvana today.
Carvana. I want to know
Carvana.
about these vending machines that stick out, that spit out cars. I want to
Yeah,
see one of those in
I'll,
action,
I'll
right?
put it up on the screen. I don't have one prepared for
I'd
you,
love to be
so I'll
able to
have to
put
send it to
in
you after.
A4 and I just see a car dropping
Yeah,
down,
no,
right?
they
That's
actually
what
give you a little coin and you put it in, and then
it's
the
awesome.
car will come down the little elevator, and there
Yeah.
you go. You get a car out of your little
Do you have to
coin you
stick
put
your
in.
hand in the bottom? Aaron, you're muted, I think.
He is muted, but he's acting out a vending machine. I'm putting that in. I have no
Okay,
idea what he's
perfect.
saying. Perfect. Great
Aaron,
explanation.
you're muted. Oh, whatever. It
All right.
doesn't
Yeah.
matter. See you
Let's
later.
get into the actual segment here. So, Carvana, symbol CVNA on the New York Exchange, operates an online platform for buying and selling used vehicles in the US, allowing an entire buying and selling process to be completed online. Additionally, the company offers 300 physical locations in the US, with some of them featuring Ryan's new favorite thing he's heard of, the unique car vending machines. However, the stock's just been volatile to say the least. It is trading at roughly $40 today. It's been actually down $1, then up $1. So I'm just going to call it $40, up about 700% since the start of the year, but that's down 89% since its pandemic high in 2021. So it's just extremely volatile. But looking at its Q2 2023 earnings, the company had revenue of $2.97 billion, down from $3.9 billion. Total gross profit per unit, however, so the unit per vehicle sold, was up to $6,520. That's up 94% over the prior year. However, it was inflated by roughly about $900 from non-recurring items, but that's still a significant improvement for the company, and it is a new record high, even when accounting for those one-offs. So great numbers on that. On the other hand, though, the number of units sold was down by 35% to 76.5 thousand compared to 117.6 thousand. So big drop there. EPS was still a loss of 55 cents, but it was a large improvement from 235, a loss of 235, with roughly about 5% share dilution over the year. However, adjusting out the non-recurring items that I mentioned before, the share loss was about $1.21 per share. The financials do follow the company's plan of a focus on profitability, which is why we're seeing this revenue drop, but a per unit gross profit growth is rising. And just a really quick comment on the revenue growth, it just shows how the previous revenue growth in 2020, 2021 was really just unsustainable. And Carvana was really just inflating its revenue growth by offering vehicles at a margin which just could never be profitable. You're taking such a slim margin, you're never going to be profitable. But overall, it's a generally good change of pace for the company. However, any good news stops there, even if that was considered the good news. The balance sheet is just not looking good. At the end of Q2, the company had a net debt and lease position of $7.8 billion, with $6.5 billion being long-term debt. For size, the company's trading at about roughly $7.5 billion market cap. And of that debt, roughly $1.2 billion is a variable rate revolver at an effective rate of 8% for this last quarter. However, after the quarter's end, the company restructured some of its senior unsecured notes maturing from 2025 to 2030, which encompasses all their debt effectively. The previously unsecured notes had a coupon rate from about 4.8% to 10.25%, resulting in a weighted average coupon about 8.2% for long-term debt. In this deal for the restructuring, though, the company is able to conduct payment in kind. So instead of cash, they're actually able to pay their interest payments with additional debt issuance for the next 2 years. So if they don't pay the cash interest, they can issue more debt to the person who already holds the debt. So selecting payment in kind, however, it actually raises the effective interest rate from 12 to 14%, up from the 9 to 11%, depending on the exact maturity. Effectively, now the company has the ability to kick down the can of their interest payments for 2 years. Additionally, as part of the deal, the company issued 4.9 million shares for $225 million through an at-the-market offering, and an additional 2.7 million for $126 million in a private placement. This roughly dilutes the company by about 7.1% over last month. Luckily for the shareholders, though, the significantly inflated share price compared to a few months ago allowed for significantly less dilution than what would have otherwise taken place. You would have been looking at 5 or 6 times compared to the start of the year because the share price increased. And that would have been, these restructuring most likely would have happened regardless of the share price. So our take although the company is moving in the right direction closer to profitability, it is still so far away from any meaningful profitability. And that's just really the most important point, as well as it's just difficult to see a path forward to profitability in the sustained long run, as the company doesn't really benefit from economies of scale. In fact, it's really just diseconomies of scale, which is why we're seeing their volumes drop, but their profitability rise. That's the exact opposite of what you really want to see. And the cost-cutting measures which they're taking can only ever be done so far. You can only cut costs effectively to zero, but even doing that, they're barely profitable at this time. So where is that profit going to come from? The business model in itself just really doesn't provide much, if any, hope. And then the debt issues on top of that, effectively putting a 2-year timeline to not only become profitable and improve, but become profitable enough to cover now this heightened interest payment, which is effectively, we're looking at really double nearly of what the previous interest payments were after the next few years. And you're now seeing, as a shareholder, remember you're buying shares in the company, you're probably going to be seeing quite a bit of dilution if they keep needing to issue shares to cover their short-term costs and any other costs that come up, because they've already pretty much maxed out what they can borrow on. I think they have a bit of room in the revolver, but even then you're paying your 8%, and they can't really fund that from operations. They have to pay either debt or pay by issuing shares or issue more debt. So you're really stuck in just a catch-22 at this point. And Carvana really is just watching a car crash in slow motion now. That's how I'll end that one.
So what you're saying is you're all in on Carvana, right?
I'm buying out of the money 300
Yeah.
calls already.
It's true. I thought so.
My question, I guess, so this is vending machines for cars. So my question is why is there a benefit in selling cars this way relative to the conventional lot? Like, one thing I can think of is that if you're stacking the cars in a vending machine, you're saving space, but you could still just stack the cars in a regular car lot
arcade,
if you really need to save space, and not call it a vending machine. So I'm just wondering how the vending machine model actually improves the experience.
Well, it got Ryan's attention.
Sorry?
I just want to see it.
I think it's just a marketing ploy.
I don't want to buy a car that way. I just want to see it. That's the difference.
It's like, sometimes when I buy a bag of chips from a vending machine, it'll kind of come out and it'll get stuck right between the
That's the main thing, right? Yeah.
And I have to shake the machine.
What if you can't get it out? Do you not get it?
For the car, right?
The next person gets 2 cars.
Yeah,
you shake the car vending machine and the car comes crashing down.
I would prefer if it was one of those hands that drop down and you can maybe get a car or maybe not get a car, and then you drop the car.
It could be like a Porsche 911 or
or like a Pinto, a Ford Pinto from the 80s. I like that.
That's actually a good idea.
Yeah,
because that would
pay $500, maybe get a car, maybe get nothing. Brennan would do it.
I don't know if I do.
I just think that this is just an example to me. I mean, maybe there is an explanation for why this would improve the experience, but I just don't. I think it sounds to me like a gimmick. It sounds to me like solution that never had a problem.
The debt looks horrible too. Like you slammed on that too, but it looks awful, and it's only going to get worse in terms of the payments on that in the near term. Yeah, I think we'd stay away from Carvana. Is it Carvana? Yeah.